All right, let's dive right into this explainer. Today, we're tearing down a genuinely fascinating piece of corporate strategy, Eni's 2026 to 2030 Capital Markets Update. Look, if you track the energy sector at all, you already know the entire industry is sitting at this massive crossroads. But Eni? Eni's laying out a roadmap that is just completely distinct. We're going to unpack exactly how a massive, established energy heavyweight plans to navigate the next 5 years, driving serious growth while aggressively, and I mean aggressively, transforming its underlying business model.
So, this brings us to the literal trillion-dollar question facing the global economy right now. How exactly does a legacy oil giant actually fund its own green transition? We're exploring a seriously high-stakes strategy here. It's all about how an energy titan plans to take these massive, highly efficient fossil fuel profits and use them to self-fund a rapid structural pivot to green tech. It is an incredibly delicate balancing act, and it requires absolute precision to pull off without alienating their core investors or, falling behind on their climate targets.
Well, Eni's answer is what they're calling a dual engine strategy. It's all about perfectly balancing two huge, very different divisions. On the one side, you've got Global Natural Resources. This is their traditional upstream oil and gas division. It is built purely for optimization and cash generation. On the flip side, you have Transition and Transformation. This houses their green business platforms like Plenitude and AnyLive, and these are built for high growth and rapid decarbonization. The entire corporate strategy basically hinges on these two engines working in perfect synchronized harmony.
But look, before you can pull off a transformation like this, you need a rock-solid foundation. And Eni has built some serious financial armor. 14%. That is Eni's projected pro forma gearing, their debt-to-equity ratio, heading into the end of 2025. It's incredibly low. Actually, it gives them the lowest leverage in the company's entire history. By operating with that kind of balance sheet and extreme capital discipline, they get the financial flexibility to actually make this massive pivot safely, totally insulating themselves against those notorious boom and bust cycles we always see in the oil market.
Okay, moving on to Section 1. Upstream, the cash generator. So this first engine is powered by their distinctive dual exploration model. And guys, it is an absolute machine. Just look at these numbers. They're consistently replacing their reserves at an organic rate of 167%, easily making them a top performer compared to their peers. But the real magic? It's their speed. Their time to market is just 4.4 years. That is a full year and a half faster than the industry average. Since 2013, this hyper-efficient model has generated over $13 billion. So they aren't just finding oil and gas, they're bringing it to market and monetizing it faster than almost anyone else out there.
And because of that crazy efficiency, we're seeing a really strategic shift in their actual production mix. While they're targeting a solid 3 to 4% underlying growth in production, it's really about where that growth is coming from. By 2030, their mix is going to be 45% gas, 40% liquids, and 15% LNG. They're aggressively expanding global gas and mega LNG projects in really strategic, high-value markets. We're talking massive hubs in places like Indonesia through their combo with Petronas and the huge Vaca Muerta project down in Argentina. Basically, gas is the bridge fuel here, and Eni is building a massive toll road.
So what does all that traditional upstream efficiency actually get you? Well, a staggering 71 billion euros. That is the projected cash flow from operations they'll generate over their 5-year plan. 71 billion. I mean, that is the financial muscle, the absolute bedrock of this whole transition. It's the exact capital that lets them reward their shareholders today while simultaneously bankrolling the energy company of tomorrow.
Which leads us to Section 2, Transition, the green satellites.
Let's kick this off with Plenitude. That's Eni's renewable and retail arm, and they are scaling fast. They're on track to nearly triple their installed green energy capacity, jumping from 5.8 gigawatts in 2025 all the way up to 15 gigawatts by 2030. But they aren't just throwing up solar panels and wind turbines in the middle of nowhere. They're integrating all this power directly with a massive retail base. They're projecting 15 million retail customers by 2030, running right alongside tens of thousands of EV charging points scattered all across Europe.
Now, here is what's truly groundbreaking about Eni's approach and what really sets them apart from the rest of the legacy pack. It's this satellite model. Instead of burying these green businesses inside a giant oil conglomerate, they spin them out as distinct entities to attract external capital. Plenitude currently sits at a 12 billion euro enterprise value, having already sold stakes to RS and EIP. Meanwhile, AnyLive, their sustainable mobility and biorefining arm, boasts an 11.75 billion euro enterprise value, which was validated by a 30% stake sale to KKR. This model unlocks massive hidden value and pulls in billions and third-party capital, all while Eni still holds the strategic reins. It's pretty much a masterclass in corporate structuring.
All right, Section 3, Unlocking Shareholder Value.
So I know what you're thinking. How does this whole transformation bridge translate into actual, tangible returns right now? Well, Eni's built one of the most transparent and aggressive shareholder reward frameworks in the industry. Their base policy locks in 35 to 45% of their cash flow strictly for distributions. For 2026, that shakes out to a €1.10 dividend per share, plus a €1.5 billion share buyback. But check out the upside scenario here. If Brent crude climbs up to $90 a barrel, they dedicate 60% of that unexpected windfall to extra buybacks. And if oil spikes above $90, a full 100% of that upside goes directly to investors as an extraordinary dividend. They are deeply, deeply committed to sharing the upside.
And to actually afford all those generous payouts, they're keeping an absolute iron grip on capital discipline. Over the whole 5-year plan, gross capital expenditure sits at roughly 29 billion euros. But thanks to the cash they're bringing in from those satellite spin-offs and tight portfolio management, their net capex is strictly capped at around 25 billion euros. For 2026 specifically, net capex is choked down to just 5 billion euros. They are really forcing their operations to be leaner and way more efficient.
Moving into the final piece of the puzzle, Section 4, Tech Fueling the Future. Honestly, Eni almost operates more like a Silicon Valley deep tech incubator than a traditional oil company these days. Just look at these long-term, world-changing bets. In 2026, they're upgrading their HPC supercomputer to hit 1 exaflop of processing power, which is absolutely critical for advanced geosciences and AI. By 2027, they're planning to fire up prototypes for quantum computing and spark technology. And looking a bit further out into the 2030s, they are actively investing in commercializing magnetic confinement fusion. We're talking about delivering limitless, clean power directly to the grid.
But, they're also applying tech to solve the immediate, right-now problems, mostly through carbon capture and storage, or CCS. They're basically taking their legacy oil and gas infrastructure and flipping it. They're turning depleted gas fields in places like Bacton in the UK and Ravenna in Italy into these massive carbon vaults. And they are scaling this fast, aiming to capture and store over 40 million tons per annum by the 2030s. It essentially creates a massive decarbonization service for heavy industry across all of Europe. So let's bring this all together. What we're really looking at here is a company methodically, block by block, constructing a bridge. They're taking the highly profitable, highly efficient fossil fuel assets of today and using that immense cash flow to literally build the diversified, technologically advanced, low-carbon energy system of tomorrow. It's all about consistent execution across those incredibly volatile economic cycles. Which leaves us with one final, pretty provocative question. As other legacy energy giants are really struggling right now to balance the demands of activist shareholders, the very real pressures of climate change, and the need for immediate profits, does Eni's dual-engine, self-funding satellite approach represent the definitive blueprint for survival and growth in the 21st century? It's a massive question, and you can bet the rest of the industry is going to be watching very, very closely. Thanks for joining me on this explainer, and I hope this gave you a much clearer, structured view into where global energy is actually heading.